Ticker symbol AMAT has returned over 70% in the past year, and today we'll be looking at one of the market leaders in a highly profitable industry and just why TipRanks actually rated this stock a 9 outperform out of the possible 10 points, based on a moderate buy from analyst consensus, a bullish blogger sentiment, and a decreased hedge fund trend. So today we'll be talking about Applied Materials, a semiconductor equipment company. In their annual report, they say that their mission is to provide manufacturing equipment, services, and software to the semiconductor display and related industries. So basically, they focus on delivering products and services that will improve the performance of the devices that are sold by the different semiconductor and display industries based on better power, a better yield, and a much lower cost. They divide their offerings into 3 different segments, the first one being semiconductor systems, which is their largest one. And here they manufacture equipment used to fabricate semiconductor chips. Then they have number 2, which is Applied Global Services. They call it AGS, and it's to optimize the equipment productivity, including spares, upgrades, and factory automation software. So we could look at this one as just them selling the different parts that they have and improving the systems of their clients. And then number 3 is display and adjacent market, which the majority of their companies would call others. Here they sell products for manufacturing display technologies for TVs, monitors, laptops, tablets, smartphones, anything you can imagine that has a screen like the one you're looking at right now. That is what they're targeting with that latest product segment. But this company really shines when we look at their financial analysis. Now, I'm no expert on semiconductor chips, but I do like seeing these numbers on a company like Applied Materials. So they have a 25% return on capital employed, which is extremely high, and they have a very solid interest coverage ratio of 34 times, meaning that they won't be in debt trouble anytime soon. They have a very healthy cash conversion of 115%, meaning that for every dollar that they get in net income, they produce $1.15 in free cash flow. And that is extremely interesting if you're the investor, because free cash flow is what you get at the end if you're the investor. And they have extremely solid profit margin of 47% and a best-in-class operating margin of 29%. They have been growing their revenue, their gross profit, and the net income for the majority of the quarters in the past 4 years. However, we can see that the net margin has been contracting and expanding depending on the quarter it was in, but it has remained decently stable. Now, this company is no fast grower like Nvidia or another one of those semiconductor companies. However, their net income actually rose by 11% while maintaining very solid net margins, which is very positive for a stable company that we want to look at investing in this channel. Applied Materials likes to leverage their operations in order to grow at a faster pace. However, they know their limits, and this is why they have such a solid current ratio of above 2.5 times and a very solid debt to equity ratio, which is around 0.3. And then when looking at their efficiency ratios, these have been extremely stable, peaking at May 2022 and now being right around average where they used to be in the past 3 years, with return on invested capital, which is the metric that we like to focus on, at around 45%, which is incredible, and I'm sure that a lot better than the majority of the peers in its industry. And this shows that management knows exactly what they're doing. When looking at the fundamental analysis, I'm glad to say that this company gets the perfect scorecard, having 8 out of 8 ticks, as first of all, it has low liability risk with an interest coverage ratio of above 30 times, which we have seen previously. Then they have a solid balance sheet, as they can pay their short-term liabilities by only using their current assets. This company has insanely consistent cash flows, especially right now that there is a lot of demand for the semiconductor industry. And I'm glad to say that this company actually does pay a very consistent dividend, which I'm sure that a lot of you guys actually really enjoy from the companies that you invest in. This company has an insane amount of pricing power, as it is one of the leaders in its industry. It's top of the class of what it does. It has been innovating, and it is one of the main companies that started this segment. And this company, of course, has organic free cash flow growth, which is derived from their organic revenue growth that we have seen in one of the previous slides. And finally, the most important point out of any fundamental analysis we always conclude is the existing moat or competitive advantage of the company. And here, Applied Materials has it as well. Why? Well, because they're a company that has extensive know-how, which is extremely hard to replace. But even if a company could come in with more innovative solutions, Applied Materials has not only the size, the power, and the scale to be a lot better and produce cheaper goods than the rest of the companies, but it also has a list of recurring long-term customers with whom they have very good relationships. And that is one of the biggest moats and hardest to beat competitive advantages that a company can have. Applied Materials now pays a dividend per share of $1.28 and it's yielding 0.62%. This can be seen as the stock being overpriced, as we can see that it is one of the lowest yields the company has had in the past 4 years, where the average could be right at around 1% or below that. One good thing to see is that, as we can see, their dividends per share is increasing a lot faster than their amount paid. And this can only mean one thing, which is that the company is also conducting share buyback programs, which is even better for the investors as they're putting their free cash flow to work. And additionally, this company only has a payout ratio of 15%, meaning that the rest of the cash they're able to reinvest it in the business, and this is extremely safe dividend. For their growth potential, I think this market is overcrowded and this company is already selling extremely global, so the geographical expansion point that we usually suggest cannot work here. However, the growth avenue of developing new offerings could work for a company like Applied Materials, such as getting into all the AI hype that is going on, trying to steal a bit of market cap from Nvidia, or not even steal the market cap, but try to look for some partnership on developing high growth semiconductor equipment. Now, when looking at the valuation from a PE ratio, we can see that it's trading at a pretty expensive ratio in comparison to the past 4 years. It hit its low of 12 PE ratio in October 2022, and since then it has rallied up to now be sitting at around 24 PE ratio. Now, when looking at their free cash flow yield of 3.21%, this is higher than the long-term inflation rate of 3%, which actually may suggest that the company could be at an attractive valuation at this point. Now, when looking at risk and possible challenges, the main risk that scares me is the worsening competitive landscape. This is an extremely competitive industry with a lot of competitors and peers producing extremely innovative products, and there is a lot of money coming in for innovation and for different solutions, especially right now regarding the AI hype. So Applied Materials would actually have to face fierce competition, invest and renew themselves and become a much leaner company. Then in terms of regulation, I don't see any hurtful possible upcoming regulation changes. The only one that I could see from the US would be for them to want for the majority of the production of semiconductors to come back to the US, but I do see this as a very long shot. Now, in terms of performance, I don't see any risk here, but in terms of market, I do see a very big risk. Why? Well, because the semiconductor industry is extremely cyclical, and the revenues of the companies inside that industry depends hugely on if the economy is in a downturn or in a boom. And right now we have been in a boom for a very long time, and in the case that a recession might hit, this industry will perform below average, or that's my opinion on it at least. But before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence before purchasing the stock. Now, I believe that this is a very good company with a very strong competitive advantage, which produces consistent, predictable, resilient, and growing cash flows, and it has a high return on capital employed, meaning that it can create value for the investor. And I believe that this is a great company and may be a great investment. However, it is in an industry that I do not understand, so I'm going to stick away from it. And it has returned around 70% in the past year, so it may be in the overvalued side. Anyways, thank you for watching. As always, this has been the Cashflow Compounder. There is a join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.